Hello and welcome to question 3 of the 2022 company financial statement preparation. What we want you to do is turn to page 8, and where you've got workings here, I want you to set up ledgers. So just draw your T ledgers up, inventory right through to vehicles there. Put your opening balances in. These opening balances are straight out of page 5, which is from your financial position balance sheet, and put your closing balances in as well. Opening being 2021, closing 2022. Just press pause now and get that done, and then we'll start again. Great. So you've set it up for success, which is brilliant. So we'll start off with inventory, work our way through, and what we're looking for is a cash component. For inventory, to reconstruct that ledger, a little bit tricky. We haven't got a bank figure here. We've got a cost of goods sold. Feel free to abbreviate to COGS, and that COGS figure is 1940. And you can see that on page 4. Total up that side, the credit side, and bring that total to the debit. And we're looking for a missing figure here. So write your 1988, and this is our purchases figure. Although this doesn't directly go into the cash flow statement, we'll need that. We'll do the accounts payable. In fact, we'll put it in here now. Put your purchases in and 1988. Good. Accounts receivable. So start off with 87. How accounts receivable increases is through sales. So you won't find sales on resource B, page 4. You have to turn over the page, revenue note 1, and you'll see it on page 6, and you've got 3720. That will increase how much our accounts owe us. Add the two together. I can't see us charging interest anywhere in the paper. What reduces accounts receivable is bank, which we're going to need. That's the one we're going to calculate. And also, just check if there's a bad debts there. You'll see on page 4, and we've got 3,000 in bad debts. For your bank figure, we'll bring that total across, and your bank figure is your 3807 minus the other two. These are the things that decrease accounts receivable. So that 3,700, we're going to add that into a cash flow statement shortly. Now, prepayment, you're told that's the general expenses here. So the general expenses are 530. Make sure you can find that on page 4. And we'll just total those two. Bring the total across. And the cash paid for general expenses, which is bank, will be the difference. These ones with bank, these are the ones going into a cash flow statement. Accounts payable, we've got opening plus purchases. So we need to look, see if there's anything else in there. Looking through the income statement, there's nothing that you can see obvious in the income statement. So turn over to the note, and you'll see note 2, discount received of $10. That'll of 10,000. That'll decrease. Other side, decrease how much we have to pay. So again, total your higher side. Take that figure across. And the figure we're missing is our bank figure. So that's our cash paid for purchases or cash paid for accounts payable. Accrued wages, fortunately, this one's a bit easier for us. An opening balance, going to put our wages in. 580. You'll see that on page 4. Total that side. Bring the total across. And simply the bank is the difference, the cash paid for wages. Tax payable. I feel like we've done this in the previous question. So you've got opening balance, we're going to add tax. That's, you'll see it at the bottom, income tax expense of 150 total. bring that across, and the cash paid for tax is the difference. Getting the hang of it, well done. Mortgages are a pretty easy one. The only change to make the side balance is we've got bank, and that's a payment for mortgage. So your mortgage has gone down by 70,000, so that means we've paid 70,000 off the mortgage. Return earnings are a bit trickier, so we've got our net profit after tax. That's the bottom figure of 390 on page 4 total. Bring the figure across. You just got to check that there's no bonus shares issued that may have come out of there. In this case, it's not. Nice and simple. The equipment. Now, the equipment one, we started off with an opening balance of 750. So you have to look here at page 7. So page 7, let's have a look. Equipment 750 at the start. Notice I've ignored land, because land starts off at $1 million and goes up. And we can see that land revaluation surplus in 2022 on page 5 is 100,000. So there's no cash paid for land. It's just the valuation's gone up. So we can look at equipment, start 750, ends up in 800. Down the bottom, it tells us equipment costing 50,000 was sold. So we'll put that to disposal. Add up that side. Bring it across. And that means we must have spent, in this case, 100,000 on new equipment. The vehicles would start off, you'll see that it starts off at 150 and goes to 165. There's a complication here because these are trade-in, but let's do the first part. Vehicle with a cost of 40,000 was sold, so that's going to disposal. That'll take us to 205. And that means we've got 55. Oops. Hmm. 40, 65, 205, 205, 150, good. All right, now this one here, normally that would be bank. However, it's a little bit tricky this one because it's used as a trade-in. So we're going to have to do some workings on that one. So the cash paid for the vehicle is going to be less a trade-in that we had. So let's put our price is 55,000. That's what we're going to have to pay for the new vehicle. We can see that there. But let's trade in. Now the value of the trade-in, have to read carefully, it had a carrying amount of 15,000. Can you see that on page 7? So a carrying amount of 15,000. If you turn back to page 4, you'll see we made a loss on sale of 3,000. So that means we traded that in for 12,000. So the amount we actually paid for it is 55,000 minus 12. All right, so that's the figure we're going to use for that. Cash for equipment is much simpler. Cash paid for equipment, it was carrying amount of 20,000. And then if you have a look on the previous page, you see we had a loss on sale of equipment 7. So we've got 20 minus 7 is just 13,000. Right, let's put that into the cash flow statement. I've widened my screen so you can see it, but you will write this in on page 9 of yours. So operating activities, cash was provided from. Firstly, we had accounts receivable. There's only one. We're going to find that bank figure here. Cash was applied to. So there's a few of these. We've got general expenses. If we're just reading across, then accounts payable. then wages, then tax. We'll put all these ones in. What do we got? The general expenses is at 548. Accounts payable, the bank figure is what we're after. Wages, bank figure, tax payable, bank figure. Good, and we'll just go back and check on page 4, see if there are any other cash expenses there. So general expenses we've done, wages, doubtful debts is non-cash, bad debts we've done, depreciation non-cash, losses non-cash, finance cost note 3, turn to note 3, and that's interest on mortgage. So let's add that in. Right, and we'll auto sum all of those. So our net cash flow from operations, let's call that mortgage. From investing activities, we've got cash was provided from. Looks like we sold, what do we sell on equipment? And that was 13,000. And we purchased equipment and purchased a vehicle. So that 100,000 is this figure here. The purchase of the vehicle was at 43. Add those two up. And our net cash flow we had in minus what we paid. Right, over the page 10, looking at the retained earnings ledger. Look, you've already done this one up here. You've got to put it in the right form. And they've been pretty nasty and they've put a trap in there just to try and, I don't know, catch out new people at it. So we're going to put the balance in, and that was the opening balance, which is this one here, that 285. But you've got to make sure you put the 1,000 on the end. That's the trap that they've tried to put in there for you. Then we're going to put the net profit after tax. I'm going to type income summary. That's where the information comes from, and that's your 390. Add together. And lastly, we're going to put our dividends in there. And we'll put bank in there. You can put dividends either. In actual fact, we better put dividends because bank was when it was paid. Done. Last two questions. The last two questions are just written questions. Again, don't get too carried away with these. They're pretty short ones. Identify the activity section the dividends will be paid in. So it's just identify. So you're going to say, well, we've done in investing and we've done operating. So dividends paid and the financing. Not bad, eh? Last one, explain the impact on dividends on closing bank balance. Always the second one, it's important to put the figure in there. So we'll say dividends will reduce and make sure you got the figure. I think we've got 150,000.